Should you buy one company's stock, or own a piece of 500 companies at once? This single decision can completely change how much risk you take, and how much money you make. Today I'm breaking down ETFs versus stocks, so you know exactly which one fits your investing style. What's the difference? Let's keep this simple. A stock means you own a piece of one company. Just one. If you buy Tesla stock, your money's future depends entirely on Tesla. An ETF, short for Exchange Traded Fund, is different. An ETF can hold hundreds or even thousands of stocks in a single fund. Feed spot, so instead of betting on one company, you're spreading your money across many at once. Think of it this way, a stock is one card. An ETF is the whole deck. The risk factor. Here's why this matters. A single stock can lose all its value if that company goes bankrupt. #investing. It happens more often than you'd think. But a broad market ETF holding thousands of stocks has never gone to zero, and has always recovered given enough time. #investing. That's the power of diversification. Individual stocks can be highly volatile in the short term. It's common for even great companies to drop 50% in a year before going on to outperform later. YouTube, ETFs smooth that right out. Why even experts prefer ETFs? Here's a stat that surprises most people. The vast majority of professional fund managers, people with research teams and decades of experience, fail to beat a simple index over a 15-year period. #investing. Even Warren Buffett has said the same thing. He believes ordinary investors can beat the pros simply by buying index funds consistently over time. FeedSpot, calling them the most sensible investment for the average person. FeedSpot, if the professionals struggle to beat the market, why try to outsmart it yourself? When stocks make sense. Now, stocks aren't bad. They have one big advantage, explosive upside. If you'd bought Apple or Amazon early, an ETF could never have matched those gains. Some stocks also pay dividends, giving you steady passive income on top of growth. YouTube, the trade-off is simple. Higher potential reward, but higher risk too. The smart strategy. So what should you actually do? Many experienced investors use something called the core satellite approach. Around 80 to 90% of your money goes into low-cost ETFs as your stable core, and the remaining 10 to 20% goes into individual stocks you believe in. #investing. This way, you get market-matching stability, with room to chase bigger gains on the side. Closing. If you're just starting out, ETFs are the safer, simpler choice. Once you're comfortable, you can add a few individual stocks for extra upside. Either way, the key is starting today, staying consistent, and thinking long-term. If this helped you understand the difference, hit like, subscribe, and I'll see you in the next video.